Hi, everyone. I'm really excited for this panel. I will say our prep call threatened to run for 2 hours as we debated this issue. So we will try to be a little more succinct today because I know we have at least 20 people here in the audience who could jump up at the panel and may in fact disagree with us so vehemently that they may come up and seize a microphone. So looking forward to this being something lively before we go to the exciting poster session. Let me introduce our panelists. So Tomasz Piskorski, professor at Columbia University, Meg Burns, the executive vice president of the Housing Policy Council, Mike Dryden from 6th Street, where he's a partner, and Jim Parrott, who's a non-resident fellow at the Urban Institute, as well as being the owner of Parrott Ryan. I was realizing sitting in my seat that it's been more than 15 years since the financial crisis, which is shocking because it's still very fresh in my memory. And I think for all of us, where we were during that time really shapes how we see housing markets today. So I will tell you where our panelists were going in the Wayback Machine 15 years ago. So Tomasz was just starting his career at Columbia, starting a whole series of papers that really have defined how a lot of us, including me, think about the mortgage market. Meg was the senior executive at FHFA, trying to figure out a way to get us through an incredible mess. Is that a fair statement?
I actually think I was at FHA first, and then I went to FHFA.
Okay,
in
so
the midst of it all.
Meg was steering two very tricky ships in the crisis. Mike was in the market, so first at Barclays and then at Credit Suisse, so experiencing the price fluctuations firsthand. And Jim was at the NEC in the White House. So we have a team that has a lot of experience from a very difficult time in our nation's housing markets, and so able to kind of tell you how do things look today with that perspective. We're going to talk a lot about the transition in the mortgage market from a more bank-focused mortgage market to a non-bank-focused mortgage market. And that is not just because I am chair of this panel and obsessed with this topic. The members of the panel have independently agreed that they find it interesting. So we're going to have 4 questions with each person starting a lightning round, so to speak. But Tomasz has kindly agreed to kick things off for us with a few overhead slides.
So Karen, thanks a lot for organizing the panel, and I just want to kick our discussion with a few facts, few slides, just to kind of get our conversation going. So first thing, when we think about mortgage finance market, especially on the residential side, the 2 kind of important developments we need to take into account is the fact that, there has been a big growth in shadow bank lending. In fact, majority of loans in the US residential mortgage market are now done by non-banks. And secondly, this very important secondary loan market. Many of you know, of course, about it, the GSE support FHA. Just to show some facts, this is what happened to the growth of the shadow bank. By shadow banks, I mean non-bank institutions that don't take deposits. They accounted for about 25–30% of lending just before the global financial crisis. Now they account for about 60%. And what are the main sources of this growth? If you look on the main factors, about 30% of that growth was the early adoption of fintech. A company like Quicken Loans is a poster child. They were a very early adopter, become the largest lender in the residential mortgage market. But about the 60% of that growth is regulatory arbitrage. Essentially, we put a lot of regulatory restrictions on banks, and a lot of our lending migration a lot of lending activity migrated to less regulated entities. The second fact that's very important to recognize from regulation and financial stability perspective is that banks, even if the banks are making loans, they also, like non-banks, sell a lot of loans they originate, especially when they are poorly capitalized. We saw it during the global financial crisis, but even now the banks sell a very sizable portion of their loans. So in some ways, we have this market segmentation. You have traditional banks that account for about 40% lending. They have balance sheet capacity because of insured deposit funding. They currently mainly specialize on average in more credit-worthy borrowers, especially the jumbo sector. And you have a non-bank, also called shadow banks, that don't have access to insured deposit funding, pretty much sell everything they originate, very dependent on secondary loan market, GSE guarantees, FHA, and so on. So how do we think about financial stability risks of that system? Let me start with, this is kind of my perspective, obviously, but I am kind of concerned actually more about traditional banks nowadays than non-banks for the following reason. And of course, we have several bank failures recently, so maybe my concerns are not completely unwarranted, but the banks are extremely highly levered. If you look on leverage as a size, there's pretty much no variation. Pretty much every bank in the US is 90% debt funded, and most of this debt is deposits and about half are uninsured, and only 10% of equity. So you can have just a fairly modest decline in bank assets, say of 10%, to end up in a situation when the value of bank assets might not be enough to cover the face value of liabilities. Of course, one example of this is the recent monetary tightening. Fed raised interest rates very significantly. What happened to the value of long duration assets, including US Treasuries, which dramatically declined by 30, 40% in some cases. And because banks have duration risk, the asset values are currently worth up to $2 trillion less than at the beginning of 2022. And as a result of that, there's a sizable number of banks in the US that are at risk of the solvency runs. I think the regulators did a good job to short circuit the run in 2023, but these risks remain. We're kind of in a multiple equilibrium world. I just want to show you there's many more banks that are subject to potential solvency run risk than Silicon Valley Bank or First Republic or Republic First. We saw New York Community Bank. So these issues are recurring. And this is just looking on interest rate effects. In addition, there is a credit risk. And mid-sized bank, 25, 30% of assets are commercial real estate loans. We calculated 14% of these loans are currently underwater, 44% of office loans. So this additional credit distress that is slowly manifesting would increase the size of banks potentially at this risk. So this is something the regulators should be thinking about. What about leverage of non-banks? And this is maybe somewhat surprising fact for some of you. The non-bank financial institutions, the shadow banks that are active in mortgage market, actually have lower leverage, especially the smaller and mid-sized ones. And that suggests, and we've done a lot of work on this with my co-authors, it suggests that actually, our interpretation of this, and of course it's subject to debate, is that the mid-sized and smaller banks are way much more levered than they would have otherwise been if they wouldn't have access to effectively ensure deposit funding subsidy. And that suggests a scope for increasing capital requirements on banks. So, and there's a big Basel III endgame debate. I have my views on that, but let me just show you what will be the impact of rising bank capital requirements on US banks. And one thing I want to say, in order to understand this question, you need to recognize this modern industrial organization of the bank, of the lending system, where there are non-banks and the banks are selling loans. So just to show you a simple counterfactual, let's start at baseline, which is 0. And suppose we'll increase capital requirements on banks. What would happen? If you look on bank balance sheet lending, you'll see a big decline in lending on balance sheet. You could naively conclude from that, oh my goodness, capital requirements are killing mortgage lending. But what would really happen, banks will change composition of their lending. Instead of keeping loans on balance sheets, they will keep originating loans. Their selling propensity will increase. And in addition, shadow banks will still, or some of the business will migrate to shadow banks. So overall, in a system, mortgage finance like US, the bank capital requirements are not as big of an impact on mortgage lending because we have this debt security market with GSE, FHA guarantees. And that's one thing I want to make to open to the debate of the panel is that in some ways, the secondary market interventions, regulations are in some ways more important because both non-banks critically depend on them, but also the banks, and they can have much bigger quantitative effects. This is kind of what we've found out in our work. The last point I want to raise, the fact that banks have lower leverage doesn't mean everything is fine. We have a very recent report on bank stability. One concern is liquidity. They don't have the access to liquidity facilities like traditional banks have. There's a lot of people in this room that did work on it, including Karen Pence, James Vickery, Nancy Wallace. And we had a bit of this evidence from the COVID-19 crisis. Early in the crisis, the banks, the non-bank servicers were modifying, offering debt for the balance at much lower rate than traditional banks, especially the ones that were more liquidity, more capital constrained. And just the last just a few thoughts for the discussion of our panel. We need to think about, when we think really about regulation, we need to take a holistic view. Debt securities market as important, as capital regulation, non-bank lenders as important as traditional bank lenders. This is where the most lending nowadays takes place. And it brings us to critical role of GSEs, FHA, and obviously it's also very much shaped by politics. We have election year, so let's see what's going to happen. And some other factors that were also mentioned in a great panel before, the mortgage locked in, rising cost of insurance, AI, fintech, and so on and so forth. So let me stop here and I'll pass it to Karen.
Thank you. That was a fantastic overview. So let me turn that to the rest of our panel. Do you agree with Tomasz, not to make it personal? And so when you think about the shift from banks to non-banks, is that to you something that makes the financial system better off, worse off? And what do you think are the drivers? So really interested in your take on this exact same set of questions from your perspective.
All right, well, so let me start with, I don't really agree with the perspective on the banks being over leveraged, but I'm not going to focus on that. And I'm not sure that I agree that a model of what we used to call originate to distribute is providing that much more stability to the marketplace. I think what we actually want in our marketplace is a variety of lending institutions with different business models. I think we want transparency around the risk and understanding of who's holding the risk and how they're managing that risk. I think we want a marketplace that's fairly regulated. I think what we have is a marketplace, yes, that's dominated by non-banks, but we have a marketplace that is dominated by the GSEs and the government, and those two actually go hand in hand. And what's interesting about the FSOC report highlighting the concentration risk in monoline entities is that the GSEs are also monoline entities. And so some of the vulnerability in the system comes from the nature of a marketplace that is so dominated by the GSEs and government securitization, which has lended itself to the growth of the non-banks. Now, make no mistake, I do think that the banks got chased out of mortgage. I think they're getting chased out of consumer lending in general. I think it's not just because of the regulatory squeeze that's been placed on them. I think it's also the reputational risk. There's a sort of negative narrative that circulates in Washington, D.C. around banks' engagement in consumer lending, which is extremely unfortunate because I do think that banks are helpful for the marketplace as a whole. I think that if we actually look at both the great financial crisis and the pandemic, banks have actually stepped up to help out. You just mentioned the banks that failed. Who stepped in to help out? That's what happened during the great financial crisis as well. We had all these distressed assets and the banks stepped in to help out. So
I thought it was a taxpayer, but
all the taxpayers.
I know it costs several tens of billions of dollars.
So here's the funny thing. So taxpayers, well, the taxpayers, okay, but I'm not gonna actually go into that, but
no, we promised we'd be interesting, so please do.
I want you to say something though about the GSE and the government dominance, because the reason it happens is because it is subsidized. It is subsidized. There is a reason that the non-banks deliver, that has become so dominant. There is a lower cost of capital for the GSEs, and so that has become the primary mechanism. And part of the risk that has been introduced is in the government space. The Ginnie Mae marketplace is much more challenging for non-banks. The liquidity demands on them in the government space are very difficult. When a loan goes bad, the servicer is obligated to pass through the payment to the bondholder, despite the fact that the borrower is not making that payment. The government credit holders, FHA, VA, and USDA, cannot step in with their insurance at an early stage of delinquency to help make that payment. That is not within their realm of authority today. And Ginnie Mae doesn't make it particularly easy for the non-banks to get funding from private financiers. So that is all contributing to the vulnerability to the system. And I don't know that I would say that it's because of non-banks per se. I would say that there's this greater dynamic at play in terms of how the GSEs and the government securitization dominates. And then we can talk later about yours.
Thank you. And I do want to give the audience, I'll call it the two-hander option. So one thing we talked about beforehand is like, all of us know this so well that we're sometimes incomprehensible. And so if you hear some piece of particular jargon and you have no idea what it means, please know you have the option for the two-hander. So just to give that. just to give that option to the possibly beleaguered audience. So, thank you. Okay, Mike.
Maybe a couple things, and obviously a little bit unique, maybe in this room or at least on this panel, in terms of having either been at a bank or been a private capital provider to these markets at different points in time. But it's really interesting just to hear Tomasz and Meg sort of talk through this. And one of the things that I think is always really important is when you think of these different spaces is origination, lending, servicing, and holding are completely different things. And I think a lot of the time people put all these different pieces together when they're actually trying to sort of talk about what the markets really are. And if you look at it, the non-banks have actually not really been sort of as active at all in mortgage holding. Where they actually play a role is on the origination side of it, which obviously includes the lending piece of it as well. And so the ability of advancements of technology and other things, it's really hard to be able to go and build IT systems sitting in a bank. Like there's lots of different compliance rules, which make it really tough to be able to do so, et cetera. And so there's a lot of reasons for being able to do that in various different environments where it can be done, and you can attract the talent to be able to do so. Banks play a hugely important role to just the financial stability of the entire systems. Being able to provide on-demand financing is massively challenging in the markets. People probably remember in the middle of COVID, as stuff was trying to get funded into the markets and there was just no liquidity. The banks were struggling because they were getting tapped on liquidity lines every which way, shape, and form, and there was just nothing in the markets until sort of the Fed and other different sort of programs stepped up to be able to do so. That's one thing that the banks provide a super important role on in that way. But ultimately, if you look at it, like for non-banks, and Meg sort of mentioned it, like you look at sort of like some of the non-banks and the size of origination volumes that they're willing to run and the warehouse lines that they're willing to run, there's no way you could ever do that. If you look at a finance company in the auto finance space, you're not as levered, don't nearly run as much risk as you do sort of as a mortgage banker, simply because of the fact that you can actually go and forward sell your production through the TBA market, which is a completely different thing. And that allows you to be able to be in a position of originating $10 billion of loans a month or whatever it may be. And so all of these different pieces, I think, are actually really important. And as we like poke on some of them and prod some of the others, it really changes different items. And a lot of it really just ultimately comes back to, and I think in the prior panel, people were talking about like Canadian markets, European markets, they're so different because nobody else has a 30-year freely prepayable fixed rate mortgage, which is the single most crazy product in the world at the end of the day, but it's been a massively beneficial product for the markets in the US. And not surprisingly, it started in 1933 coming out of the Depression, which has very important impacts to it as well. But if you just look at it from just an overall perspective, that completely changes that dynamics. And if you think of banks holding fixed rate, freely prepayable products is not really what banks are supposed to be doing either. If you look at it, I think going into 2022, banks held like 58% of their assets were fixed rate. That's not historically where banks were. If you look at the S&L crisis that happened back in the 80s, a lot of it had to do with the same sort of thing, lending long and borrowing short. Duration is a real challenge. And I think one of the things that everybody, I think overall, and as we think about it, non-banks play a role. Their role is a certain role in it. The question really I always get back to, who is the natural holder of these assets? Because if you can understand where at the end of the line, who's that holder, then trying to be able to piece its way through, that's what creates the stability in the markets in general. And holding a 30-year fixed rate, freely prepayable product that's not government guaranteed is actually really tough. And if we want to have rates at certain levels, if we want to have mortgage rates at certain levels, how do you actually factor in that duration risk? And so it's just something important to think about.
So to your question of whether or not the rise of the IMBs is a good thing or not, I actually think on net, it's a sort of logical and positive step in a long evolution of the market. If you go back far enough, as long as regulators can keep up, and I'll come to that in a minute, which we can get to your report, is sort of a segue to that a bit. If you go back far enough, we're in a world in which those that made loans held all the risks associated with loans. They held the credit risk, the interest rate risk, the servicing risk, the operational risk, all of it. Whether they wanted to or not, that was their option. If they wanted anything related to mortgage risk, they had to hold all of it. With the rise of securitization, you gradually saw some disaggregation of the risk. Some of the interest rate risk got sent off in the MBS market. Some of the credit risk got sent to the newly formed government entities, but still most of it's sitting on the balance sheet of depositories. With the rise of IMBs, you've seen sort of the third wave of evolution in all this, I think, which is the rise of the main originators in the system, whose function is to disaggregate all the risk. You know, they pull it in the front end of the system, and then it all gets broken apart and sent all throughout the system, where MBS investors are taking almost the totality of the interest rate risk. The government, to Peg's point, is taking almost the totality of the tail risk on the credit end. MIs are taking some, first loss credit risk in this, and then the government's then selling back some of that tail risk to the CRT market. So you've got a amazingly parsed, disaggregated risk in the mortgage system all through the ecosystem in ways that just are a lot more efficient in some respects than what we had, 60, 70 years ago. And it keeps costs down if it works right. It keeps mortgage costs down. It allows those that want to invest in a specific kind of risk to just invest in that risk and not four other kinds of risks they don't really want, which increases the amount of investment you've got in the space. It allocates capital pretty efficiently. And so as long as regulators and policy can keep up with that evolution, which is obviously what you guys report is sort of about indirectly, then I think we're moving towards an increasingly efficient, rational way to deal with the mortgage market and to deal with the goofy 30-year fixed rate mortgage, which we've all become addicted to in a good way. I'm a fan. And I do think that the government ends up being a really important part of that. So I've increasingly become a fan of a big footprint just because coming through all the disruption of the last 15 years, looking at what happens within the government footprint in those moments of stress versus what would have happened had we had a PLS market that was 80% of the market during COVID, for instance. It's hard to even get my head around what that looks like. So I've gotten increasingly comfortable with the government sitting behind this ecosystem and dealing with the tail risk just for stability reasons. But it's going to be important that for regulators to figure out a way to deal with what is sort of the newish acute risk in the system, newish meaning only a couple of decades old, which is the liquidity risk that we didn't have back when banks were holding everything. And that's a no joke kind of risk. And some IMBs are in a better position to handle that than others. And I don't think of that as much as a regulatory thing, as much as it is making sure we've got stable sources of liquidity out there for those times when we bump into an iceberg, whether we can see it coming or not, to make sure that those that are now playing the intermediaries and sitting the capital around this increasingly complicated system have the liquidity to do that when the borrowers aren't paying their mortgages anymore and there's no liquidity to then pass on. So making sure that those intermediaries have access to liquidity when warehouse lines begin to freeze up or reprice, I think is important to making sure that this next sort of 3.0 version of the mortgage market is actually stable and not just efficient in other respects.
Thank you. And for the benefit of those of you who don't fully know what we're talking about, the Financial Stability Oversight Council released a report last Friday, which talks about some of these issues. And so you'll find kind of a simplified version of what we're talking about here in that report. So.
Super well done. Really, really well done. Karen and company.
That's a little pandering to the moderator, but we'll the moderator's susceptible to flattery, it turns out. So turning to our second question. So we'll start with Meg for this one. So we've talked about it from a financial stability perspective, and of course, consumers benefit from a stable market. But putting that aside, do you think consumers are better off or worse off in the market that we've transitioned to?
Well, I like that you asked the question not about, market where we've evolved to a dominant non-bank status, because I have concerns about the dominance of the GSEs and the government in terms of consumers, because what we don't see enough of is innovation. And I worry that we will continue to stifle innovation as we see this GSE and government dominance continue to expand. And I don't see a way out of it right now because it's self-perpetuating. And so let me explain what I mean by that. Because I know that a lot of people fundamentally believe that there is some good innovation happening in the GSE space, but And I know that Sam was just on the panel, and I have so much respect for the GSEs and the talent that they have within those organizations, but they just issued their equitable housing plans. And when you look at the numbers of borrowers who are served by these new special affordable housing programs, they are abysmally low. The place where we really would need to see some innovation happening is in the government agencies, and they don't have the resources and they don't have the autonomy to actually build out new and innovative programs. And so what we instead have is a reliance on, old school underwriting and old school thoughts and ideas around how to help consumers. And in the GSE space, what that generally is two things. One, we relax the underwriting standards, and two, we reduce the cost and we subsidize the losses that are associated with that, and put it into the affordable housing goals or put it into duty to serve, and we act like that's okay. That's actually not a great method. It's not really helping us accomplish anything. We see people in the consumer advocacy community telling us that the Black homeownership rate is as low today as it was during the passage of the Fair Housing Act. Well, then let's stop doing the same thing that we've been doing for the last several decades and acting like we're going to have a different outcome. We actually need to roll up our sleeves and take a look at some of the fundamentals around the underwriting and make some program innovation. And I believe that it could happen outside of the GSE and the government context if we could allow that part of the market to open up. It was one of the reasons that we struggled so hard to change the QM definition. We felt that the qualified mortgage definition, relying on the GSE patch, where the GSE approval essentially became the mechanism by which all loans became QM, it stifled the ability for QM to happen outside of the GSE context. And we had hoped that if we could open that up, we could see some innovation outside of that space. So that is one of my concerns. There are other ways that we could solve for that, which maybe we'll get to in this discussion, but that is a worry that I have.
Thank you. Mike?
Yeah, maybe just on a slightly different topic than Meg was talking about, like one of the things that that I do believe is important as you look at sort of the overall market is, and it's pretty fascinating to look at. I get pitched all the time on different sort of new strategies to try and put capital into products like home ownership appreciation programs or all of these different items. And one of the biggest challenges in the US system for private capital providing like financing into the market has historically been consumers actually finance more efficiently than institutions. There's almost no other market in the world, literally in the world, where an institution actually funds itself weaker than a consumer. And the reason for it is because of the fact of, again, GSEs and the government. And that's great. Like at the end of the day, as we're talking about it as relates to the consumer is definitely getting that benefit in certain ways. To Meg's point, does it get to everybody? Is there an ability to be able to look at some of the different pockets of affordability in different ways? It absolutely needs more work to be able to do so. But one of the biggest challenges is we always look at it and people come to us and say, we want to set up a program. We want to be able to partner with folks to create more affordability products. If we actually can't figure out a way to get that into Fannie, Freddie, Ginnie, it never actually works because we can always put capital up, but our capital is going to be way more expensive than any other capital that's in the market. And so this dynamic to me is a really important understanding. And how do we think about like what the charters are of the GSEs and Ginnie to be able to think through what the affordability is and actually figuring out how to partner with private capital to be able to do so. Because sitting in our seats, as I look at it, half the time you look at it and you're like, there's just no way. It's just not going to work because the risk adjusted returns that somebody needs to actually earn, you actually can't make the math sort of pencil out. And so I think that as we sort of think through this, there's a lot of good that comes from how the market works from like a top-down perspective of being able to create really efficient sort of mortgage pricing to the end consumer as much as possible. But then how do we try and figure out some of the pockets to be able to really sort of drive what desired outcomes are from a policy perspective into various different other areas? And it's been hard because one of the other challenges is like, I always sort of joke, if you allowed the GSEs or anybody else to be in a position associated with their charter to go do something that was completely different than the mortgage space, they'd be the best bid in the market as well. And why would they be? Because they've got the lowest cost of capital. And so from that perspective, it's just going to dwarf anything else. And so how do you try and ensure that you actually are pointing things in the right directions to be able to do so, but being able to then target those specific areas? And I do think this is where non-banks, private capital, and sort of various different government sort of bodies can come together to be able to try and drive it. It's just hard. It's hard to be able to get those policies to sort of work together, but it's an area that I think just constantly needs focus. And if you look at some of the public-private partnerships, Karen and I actually met during TALF, like you look at some of these times, those are some of the most important times I always think about because they actually really help to sort of drive that innovation.
Yeah, so when I think about the market structure that we've got now, whether it's better for consumers than the one we had 25, 30 years ago, it seems better for most consumers in two respects. One, I think the technology sort of explosion that some IMBs have really driven, not all, but some, have made it the mortgage experience almost fundamentally different than it was, 25 years ago. One's options, the efficiency with which one can get a mortgage, the ability to turn that over quickly, one's knowledge about access to knowledge, information, knowledge about one's mortgage, all that stuff is just very different than it used to be, in part because of IMB leading sort of technologies. I think the efficiency of capital allocation I mentioned before, keeping mortgage prices down, I think that too is a positive overall. But to Meg's point, the big question I think is whether or not we're serving historically underserved communities any better than we were 25 years ago. And I think it's a little hard to argue that we are. It's hard to blame any one model. I mean, IMBs have been eating banks' lunch over underserved communities now for the last 20 years. They've taken all this market share, FHA market share from banks, but the homeownership rate for communities of color hasn't budged in forever. So it's not clear that the big picture has gotten that much better. It's just that IMBs within this current model seem to be a little better at it than banks. And I think one of the problems, and you guys both alluded to this, is the way the tools that we tend to use within the government space anyway are pricing the credit box. So how do we help? We lower the mortgage rate just a little bit. So you got somebody that can't afford to get, to buy their first home, and we offer them, a 7% rate as opposed to a 7.25% rate. I mean, as if that's going to like suddenly make them miraculously financially able to buy a home. And so one of the things that I've always thought was the case, and Ed and I wrote an op-ed on this, Meg's colleague, expressing frustration at the limited tools the government agencies and the GSEs tend to use to allocate the subsidy that they're using to try to expand homeownership in communities. And we argued that instead of just fiddling with pricing at the edges, and it's still okay to help with the edges because sometimes that's what people need, why not allocate more of that subsidy to down payment assistance, because that's what some people need, or one of Ed's ideas, which I like, is a lot of borrowers who are high risk are very sensitive to economic shocks once they get in their house. So their default rate tends to be much higher. They're much more subject to a health event that throws them sideways, a divorce, that kind of thing, because they don't have enough cash in the bank to weather a storm like that. So why not incentivize them to have savings, housing related savings accounts that you subsidize in order to keep them afloat during difficult times. Think more creatively about what the folks that we're trying to help actually need, because not all of them need an extra, 25 basis points in an interest rate. A lot of them need something else. And we've been stuck within a certain pretty cookie cutter approach to subsidy for a long time, because it's just easier for those institutions to allocate the subsidy that way, rather than thinking about what those we're trying to help actually need on the receiving end, which I think is part of why we haven't seen much of an expansion when we've been dedicating all these resources. We've got this increasingly complicated and fancy schmancy ecosystem to allocate resources that hasn't gotten into these communities any better than the old clunky one we had 30 years ago.
Can I add something to that, just because he keeps referencing my colleague? He keeps referencing my boss. So one of the things that we talk about with that, I'm sorry, Tomasz, I will not take much of your time. One one of the reasons we talk about this idea of using the subsidy in a different way is because we see it as use the subsidy in a way that reduces the risk of the transaction as opposed to increasing the risk of the transaction and having to subsidize the loss. That's the change that we would like to see. We would like the dollars to flow into the transaction in a way that it actually reduces the risk of the borrower's profile. So you don't need, so the cost isn't being the price isn't being subsidized per se. The risk was reduced, so the price is reduced. The risk is reduced, so the loss is less likely. And so you're not subsidizing loss. You're in fact putting the dollars in to reduce the risk. That's the way we like to think of it. So.
I just want to echo the points on benefits of non-banks. I think one benefit, they were early innovators in fintech, but that innovation benefited more credit-worthy, more affluent borrowers. Like Quicken make you able to be refinance your loan in milliseconds. They actually slow down when you go to Quicken and you get a loan. It takes milliseconds, but for psychological reasons, they slow down and pretend like they work on your application. They don't. We just don't like to get rate in milliseconds. We want to verify this, verify that. This is just all smoke and mirrors. It's super quick. But who it benefits? Folks like us. You know, the more credit-worthy, more affluent. It didn't help democratize credit. So in that sense, it benefits folks, but maybe not the ones who would like to benefit the most. But you know, we should still appreciate these benefits. It's more of an economy premium product. It actually does not decrease cost for during its rise. Quicken was one of the most expensive lenders, and yes, customers love it because they get a somewhat higher interest rate, but they pay for convenience the way you pay for a bigger seat in an airplane. It costs more money, but it's more pleasant. And they specialize essentially in pleasing or credit-worthy borrowers. I think one area when non-banks helped, and I mean the welfare consequences of this are up to debate, is when the regulatory burden was imposed after the global financial crisis, and there's a question whether we like or not these regulations. In some ways, the non-banks, and especially non-fintech non-banks, provide the safety valve when a lot of FHA lending went, because they don't have the same regulatory costs and exposure, which means that presumably, if say non-banks would not be allowed to make FHA loans, the FHA cost will be higher because the banks will price in the legal risk. And now, of course, the non-banks are making FHA loans, but with a lower regulatory oversight. So it's up to debate whether this is more beneficial or not from the broader sort of welfare perspective and regulatory perspective. But certainly, I think the lower income, more risky borrowers benefit from that they can get presumably somewhat cheaper loan from an FHA compared to going to a traditional bank.
One thing just to add to both what Tomasz and Meg were just sort of saying is that I always think it's really important to think through is it's no differently than like what's speed and running. It's just distance of your stride and how many strides you can possibly take. Like the mortgage market or any market is the speed with which you can actually, and somebody talked about it earlier today about 4.3 million units, and it was 30 million units or whatever it was a couple of years ago. Like if people just like do that math and how many actual mortgages that means that are actually getting done and how frequently it is, capital velocity is utterly key. And there's a convenience element to it, but really when that actually gets factored in, and people may not in their own mind completely sort of correlate it to it, but like convenience is actually just about capital velocity. It's your own time. And so at the end of the day, how do you price your time? No differently than if Quicken can shorten the time frame to which it can actually originate a loan, pool a loan, deliver a loan from 30 days to 15 days to 11 days to 3 days. That just increases the capital velocity, which does decrease the cost of the system. And so the ability to be able to figure out how you actually increase capital velocity, but do it in a stable way that doesn't create greater risk to the system is part of the challenge. And so these are the things that, again, I think as we're working through it, and it's hard, as Meg mentioned, like how do you get that to parts of the market that have historically been underserved, but still in a capital velocity fast way that can be underwritten really quickly. And those are hard things to be able to do. And the FHA, frankly, was a huge element to that, to be able to increase that ability to be able to do so over the last period of time because of the fact that the non-banks partnering with the FHA to be able to do so. And so capital velocity, again, I just think is a really important thing as we're all thinking through this as well.
Thanks. And Mike, you actually have the floor for the next question. And I'm conscious of the fact that we want to leave a little time for the audience. So speakers, if you could keep that in mind, but I'd say, so you're so we've described all the problems and all the way the system doesn't work. So now you're talking to powerful policymakers. What do you tell them they need to focus on? Like, what are the 1, 2, 3 things that would really move the needle and get the system to where you think would be a better place?
I'll give one, which I fundamentally believe that what is usually misunderstood in these different discussions and for policyholders to focus in on is around liquidity risk. And if you look at it, and Tomasz showed a bunch of slides earlier about like capital and leverage ratios, I think capital and leverage ratios are important, but everyone always immediately turns to shift to let's focus on capital. We need to overcapitalize. There's too much leverage in the system. To me, I always go back to what is the asset and liability management risk that institutions are taking, and that is everybody from an individual, and frankly, again, back to the 30-year fixed rate mortgage, that creates massive stability to consumers of actually having a fixed rate mortgage. On the other side of it, banks and the liquidity risks that they've taken, I think we've all woken up to something where it's been a 35-year one-way trade as it relates to rates, and as that is now reversed, now suddenly asset and liability management risk has really mattered again, and how do you be able to really focus on that? And I always find it interesting that most of it, again, always goes to capital, put more capital in. Like capital is a tricky thing. Like you overcapitalize something, people are going to have to take more risk to try and generate an ROE. But actually what amplifies that risk is always liquidity. And so that amplification is actually really the challenge. And why at times like this do we actually see like real mark-to-market risk associated with bank balance sheets, et cetera? It's because of duration. It has nothing to do with actually the credit risk side of it. Credit risk can cause it and can be a causal sort of impact to it. But at least if I was sitting here in that, I'd be focusing all the attention on how do you actually create more liquidity programs for the system. Again, you go back to the middle of COVID, and Karen and I may have talked frequently at that point in time as well. It's like, what can you do to get liquidity into systems? Because at the end of the day, it's like, that's what's actually going to topple stuff. It's not the credit side of it.
100% agree with that. So when I think about the way you had framed this in prep was you get to be like a magic housing czar, which is a great narcissistic sort of charge to it. You have a magic wand. What can you do? That kind of thing. It's a nice frame. I too would focus first on liquidity, and especially for IMBs. And again, I think of it as making sure that you've got a system that is robust through the cycle, that will be durable through the cycle, that one doesn't have to panic about whether or not it's going to be there in an affordable way when everybody needs it. I think some of the things that you guys suggested in the report are exactly where one ought to focus. I don't know whether, Ginny's PTAP plus thing is the right way to go, or whether or not it's a different government kind of facility that's there through the cycle, that's not priced in a way that it's omnipresent the way the flubs are, but it's not so prohibitive that the big guys don't want to, there's a cash window like reputational risk. I mean, you want it to be there and used when we need it. So figuring out that part of the puzzle then means that the regulatory regime will effectively have evolved along with the system that we want to kind of keep in shape. And the other thing that I would focus on, which is a little passé, and we always talk about this in an event like this, is GSE reform, only because the risk of not nailing down what we like about this system is really high. We've sort of taken it for granted that in conservatorship, we're going to have this forever. It's always going to function this way. But we're, 1 or 2 big policy decisions away from the system changing pretty dramatically if you've got someone who wants to change it. So I think locking down what we think is most important about the system in a way that's durable, that can help us do the things we've been talking about in a thoughtful way is where I would focus a fair amount of time too.
And just to kind of make a few further points. So when I think about the regulation and the way we implicitly provide various subsidies, implicit, explicit guarantees, really these 2 big entities, the FDIC and support to traditional banking, and GSEs. So I think we need to really understand that, we can impose more regulation on one, the activity will move to the other. We need to understand the cost of that. Ideally, at some point, we'll move more and more towards private signals and pricing it correctly. And obviously, non-banks are very dependent on, in a different way, on some form of public support through the GSEs, through FHA guarantees. But I just want to kind of make a few quick points, like, you know, if we, both banks and non-banks have access to the same GSEs, it's very hard as an economist to write model that pretty much every single bank has 90% debt funding. We would expect some variation in it. So obviously banks are borrowing up to some regulatory constraint, take advantage as much as they can of insured deposit funding with some mixture of uninsured deposits. And I just want to say that I'm still think the leverage is important. And even like Silicon Valley Bank is actually a perfect case of solvency failure. This bank have enormous amount of liquid assets. They simply lost a lot of value. So they couldn't sell. They could sell their treasuries in milliseconds. The problem, they were lost 20, 30% worth less than they were a year or 2 years ago. And that's why fundamentally it failed. But I completely agree. Liquidity, of course, is important too. And so I would just say that, you know, we should really look on this holistically and think about how much this support really costs. Does it go to the place we really want to see it? And, you know, and that's why I like CRT program to an extent, provide some private signal into what is the cost of the G fees, the guarantees. And I think I very much want to echo the point, you know, thinking about reform, we don't have really a private mortgage market in the US right now. We never really had over the many times. The question how to reform it and make it maybe a little bit less dependent on implicit or explicit taxpayer support and whether this is desirable.
Can I just make one quick point, just on the back of what you were saying, which I think is a helpful complement, hopefully, to that is, at least being a markets person for my entire career, like liquidity is an illusion. And what's really interesting is everybody always wants to talk about that agency mortgage MBS is liquid. It is, but the question is liquidity at what price? And those are like two completely different things. And it's fascinating that as people saw when the BTPP program was rolled out, why was it rolled out at par was because of the fact you could then suddenly turn something that was theoretically a high quality liquid asset into actually something that could be monetized at par. That's a very different thing. And so this is where, again, it was fascinating, having dealt with banks for a long period of time. You talk to people, everybody wants to talk about liquidity this, liquidity that. And it's like, yes, can I go on TradeWeb or can I go and sell treasuries at a given point in time? But if I have 10-year treasuries and stuff widens by 20 basis points, I'm going to be off 2 points, like just definitionally. And so duration and price risk is as important as sort of how to think about what is something that actually is saleable and not saleable at a point in time as well, which again, I just think is fundamentally at times struggles with. And it's hard because at the end of the day, rules are set up and capital rules have been set up to protect against losses in a system, but losses from a credit perspective, less so from a pricing perspective.
All right, well, I'd love to comment on this systemic stuff, but I think I'm going to choose something else from my long list of items that I would try to fix if I were the czar. And that is, I would actually try to pull the 3 government credit agencies, FHA, VA, and USDA, out from within the bureaucracies where they are trapped, give them some autonomy, give them resources, give them, you know, lawyers who work directly for them, give them contracting specialists who work directly for them, give them human resources staff who work directly for them, give them authority to pay staff what they need to be paid, give those government agencies, the first loss credit risk holders who then would have the ability to create innovative new programs, an opportunity to do so, an opportunity to thrive, an opportunity to provide the kind of support to the marketplace for the types of products that might actually make a difference. That's what I would do.
Thank you. Okay, lightning round, but future predictions. So what do you see coming down the pike? And so how are the mortgage system and regulatory response going to continue to evolve? So let Jim go first with that question.
It's a lightning round. Oh my God. I think it all depends on the election, to be honest. I don't want to get like overly partisan, but I think if Biden wins, I think you'll see them focus on a version of GSE reform, which will be moving the GSEs into a utility-like direction, which feels a lot like what we've had in conservatorship, but will be more durable. If Trump wins, I think he will try to do what he tried to do in the first Trump go-round, which is pull them out of conservatorship. It'll be a complete mess. It won't work, but it'll still be very disruptive. So I think it's one of the biggest underappreciated items of variability in the election, because I think the paths, depending on the election, of this space are dramatically different. And we've seen versions of both before, so we should know what's coming. And one path is pretty scary to me. So that's my like.
Thank you, Tomasz.
What happened to those audience questions? I mean, I will admit, I don't actually see anything really substantial coming out of the government with either administration. I'm sorry to say that because I like to be optimistic, but I feel like there are some really significant market constraints. And I would like to believe even that they would act upon some of the FSOC recommendations with slight variations on them, because the recommendations are a little tepid as they're written, but I don't see anything really significant coming anytime soon.
All right. Thank you, panelists, for leaving some time for the audience. We've got a lot of questions. Well, I guess I see 3 questions. I will start in the way back in the dark blue jacket.
Thank you so much. Such an interesting panel. I really appreciate it becomes a debate in this way. My question may be more, on the fire. One thing that I didn't hear anything about was the Federal Home Loan Bank system, which is yet another GSE that was once founded to inject more liquidity in the mortgage market, right? But we've seen over the last, basically since the 80s, really, with the rise of secondary markets, that they haven't really been fulfilling that role anymore. In fact, recent research by Bloomberg found that 43% of Federal Home Loan Bank members had not originated a single mortgage over the last 5 years. So my question to the panelists is, well, what's your stance on Federal Home Loan Bank reform? And do you think it still can play a useful role in the mortgage market specifically? Perhaps, is that a source for innovation? Can they do more?
Back to the liquidity comment. I think the Federal Home Loan Banks are a really important source of liquidity system-wide, and that if one focuses only on the liquidity they provide that is housing specific, it's not appreciating the broader sort of buffer they provide ahead of the Fed, so that keeps the Fed from having to jump in as early and quickly as they would have to otherwise. For a whole bunch of reasons, the members of the Federal Home Loan Banks have a comfortable, easy way of accessing liquidity through the cycle that creates a buffer for them that pushes the need to bring the Fed in out to a more remote position, because it's hard for the Fed to jump in the way that they have to when they do have to. And it's more stable than warehouse lenders, which, as we've all talked about, can kind of come and go. So if you reform the Federal Home Loan Bank so that they're not playing that role through the cycle, you need something else to play it. I mean, it's a little Rube Goldbergish that that's what they've come to do, because that's not quite why they were set up, to your point, but it's what they now do. And so if we're going to pull them out of that role and give them some other role, we need something else to do that. I think one way that Sandra Thompson's signaled in her report that we might see them provide a tighter nexus to housing, because the nexus has gotten to be loose over the years, is right now the membership requirement has a really high housing nexus requirement to get in, and then it collapses when you have an annual assessment. So you got to do a lot of housing to get in the door of the club, but once you've gotten into the door, you can give your housing to somebody else, and the bar gets to be quite low. She has sort of signaled interest in making that annual hurdle about as high as the entry-level hurdle. So it doesn't mean that the Federal Home Loan Bank's advances are going directly to housing as a use, which is a complicated way to have the support work, but it does mean that those they're supporting are going to end up having a more durable role of supporting housing than they do now, which I think is actually a helpful thing. And then the second thing is they absolutely ought to double the affordability requirement these guys pay. They don't pay taxes, so you ought to at least crank up their housing affordability obligations to roughly reflect what taxes they're not paying.
Maybe one just quick point on that too, that's at least I find interesting. So post GFC, we got asked a lot about why not covered bonds, and could covered bonds actually be something that could replace the Federal Home Loan Bank system? Or actually, that wasn't even that discussion, but that was sort of the leading trend towards it. And it was like, actually, the reason why covered bonds don't really exist in the US compared to in Europe is because of the Federal Home Loan Bank system. What's actually fascinating though over time, and to Jim's point, is it went from the Federal Home Loan Bank system actually providing not just liquidity, but actually, again, duration matched funding for banks, to suddenly they became a lender of liquidity support at the time of need of liquidity. And that was a very dramatic shift that ended up happening. And if you go back and you look at it in time, again, part of this has to do with rates. And it's like, why bother borrow from the Federal Home Loan Bank system if I'm in a position where my loan to deposit ratio is now below 100, all these other items. But the ability for the Federal Home Loan Bank system to continue to provide match funding financing, to me, is a massive, massive point into the market and can be very beneficial for, again, just housing stability and all the rest of it. But it's what is the goal of what the Federal Home Loan Bank system is? Is it a liquidity provider at a point in time of need, or is it actually a fundamental part of the system that actually provides ongoing sort of financing in the markets as well?
I guess I have two more questions. So just to go in order, navy blue jacket, and then over there, and then finish up with you if we have time. Okay.
Hi, thank you. My name is Ethan Freshwater. I'm with Rocket Companies, formerly known as Quicken. There was a comment made about our turn times and intentionally slowing them. So I had a question for Tomasz. I'm genuinely curious because I do have some experience on our product side before moving out here to DC. And I do not know about anything about intentionally slowing down things, but I do know that we close loans 2.5 times faster than the industry average. And I was just curious, one, and what was prompting that statement? And two, are there any initiatives that you're working towards to speed up the process for refinancing? One idea that comes to mind is there's a 3-day turn time that we have to wait after issuing a closing disclosure. So it's not possible to do an instantaneous refi today.
So what I just meant by this, there's a huge research in marketing on artificial delay for consumers. This is not about actually making and selling a loan being artificially slowed down. It's the moment you file your information on a website, the moment you get the first quote of a rate, it doesn't sometimes take as much time as it seems to take. You know what I'm saying? So, the computers can compute things extremely fast. They don't need to verify your labor information. They do this, do that. So, a lot of companies, there's a whole literature on that in business. Do intentionally slow down a little bit this process because it's better perceived by the consumers. But it's not it was just kind of an anecdote. It's not essential in terms of financial stability, slowing down selling costs. That's not what I meant.
The process of collecting the 6 criteria for TRID is a personal conversation. So we'd prefer that to be done over the phone with the person rather than over a computer. So that's why it takes some time.
Thank you for that clarification. Okay, in the back.
Thanks. Philip Kalkman, University of Cambridge. So I think most of us agree that the credit box cross subsidy is an inefficient and risk incentivizing mechanism. But typically in finance, what it means to make things more affordable for the borrower is for the lender to forego more profits, whether that's by earning less on safe loans or by subsidizing losses on risky loans. So it seems to me that as a profession, we do this dance of pointing out that aiding high credit risk borrowers means incentivizing risk or subsidizing their losses, but it's the only effect that the credit box lever can create. And I wonder if we should acknowledge that the community that we want to help with these subsidies are greater credit risks because of historic housing and lending discrimination, and is not the most efficient solution to that problem, a lump sum transfer, which goes by the taboo name of reparations.
I wasn't expecting you to end the question like that, so I wasn't expecting to answer a question about reparations. So maybe I'll let somebody else answer on reparations, but I do want to say I love the question other than that point, because there is this strange conversation in Washington right now about how to cut costs, how to cut origination costs, and the focus is on the types of risk mitigation activities that are part of the process. What can we cut out? What do we not need? And the people who are asking the question don't seem to appreciate what that activity is intended to address. Why do we do this? Why do we look at a credit score? Well, we're trying to gauge the borrower's prior history of satisfying their obligations because it tells us something meaningful about the future. Why do we do a title search? Well, we do want to know whether there are encumbrances against this property that could stand in the way of a new primary lien. We have reasons for doing what we do in the mortgage space, and to cut the costs by saying, well, we no longer need that function is in fact rather dangerous. Now I'll let somebody else answer the question about reparations.
Well, I think instead I'll let Lee Chang have the last question, so.
Thank you.
Thank you. This is Lee from Recursion. So my question is regarding the Ginnie Mae servicer risk. As we all know, Ginnie Mae servicing is quite different from the GSEs. One of so they're supposed to be advancing PNI as long as the mortgages is in delinquent and before they're assigned to FHA or VA, those government entities. However, I learned from the servicers and also government contracting companies that the claims the services fired to FHA a lot of times are rejected. So when we are assessing the risk, we think, oh, it's a working capital problem. But it's actually more than that because a significant amount of claims are not reimbursed. Is there any data and research and regarding this topic, and is there a way to quantify the risk of not getting the payment reimbursed?
I think repurchase, it tends to go up and down, and I don't know, Meg, you know the numbers, but we had a spike in prepayment requests. I think at Fannie and Freddie, I'm not sure about FHA, about a year ago, and they've begun to come down a little bit. So I think they're by historic levels, they're kind of low. And I think, although somebody else can correct me with numbers if need be, but I think the bigger stress because of the modest numbers there in the Ginnie channel is where the GSEs limit the amount of time the servicer has to advance payments. Ginnie doesn't. And so that you've got to advance these payments all the way through to foreclosure in some cases, which can take years, if not months. And so one of the things that FHA, to their credit, is working on now is speeding up the turn time for their claims payments, which is for T&I, not P&I, so taxes and insurance. And with the thinking that if they can make those payments in a matter of weeks or low single-digit months, as opposed to high single-digit months or longer, it makes the liquidity stream we're talking about more manageable. And then there are other conversations at Ginnie about how to handle the advancing burden of P&I. So I think they're rightful. I think HUD as a building is focusing on the right pieces of this. I don't know whether you have.
I mean, I think what you're actually talking about is when FHA won't pay the claim.
Yes.
Which is definitely a problem. I do not think that there's any actual research that's been done where there are numbers out there that show you proportionally. And I think it does ebb and flow depending on what's happening. So, for example, one of the times when FHA is very clear that they will not pay a claim is when a property has been damaged, it's gone through foreclosure, it's been damaged, and it's not in what they consider to be conveyable condition. And so they will not pay a claim. So all of the costs that have been, any advances that have been made, all the costs associated with the property and, foreclosure process, everything, that becomes a burden on the institution, that is for sure. And after natural disasters, that is always a huge issue.
Coming out of the crisis, it was an enormous issue. So you had this tangle, the servicing was a mess, but you had this tangle of False Claims Act underwriting related claims by FHA going at servicers, and then denials of claims, which were spiking. MIs were also denying claims around the same time. So you had this, at the very time when you had a spike in defaults, you had a lot of folks looking for reasons not to pay the tab on what they had assumed insurance-wise, some of which was reasonable, some of which less so. Those numbers have come down a lot, I think, since. So it's not quite as big of an issue as it was 15 years ago.
Well, I don't want to steal any more time from the poster session because I know we've got some great posters to look at, but our panelists here have laid out, I think, a 30-year research agenda for the accumulated people in the room. So I'm glad we have so many smart people here and online. And if you could please join me in thanking them for all their insights today.